Hi, this is Brent Threadgill from Pacific Financial Technology, and today we're going to do an overview of Pacific Financial's proprietary IV gauge. However, before we start, I need to point out that options are not for everyone. And that can't be stressed enough. They're not for everyone. So you need to obtain and read a copy of Characteristics and Risks of Standardized Options before trading. You can get that by contacting the Option Clearing Corporation, or OCC, at 1-888-OPTIONS, or mailing a request to the address on the screen. So if you haven't already obtained that, pause the video now, write down either the number or address of the OCC and contact them to receive a free copy of the Characteristics and Risks of Standardized Options. Okay, now we're going to look at a chart of a hypothetical stock we'll call XYZ. This chart shows XYZ's price from January through March, and as you can see, it traded close to 30, then traded down to 14 in February, and then came back to 20 before March. Going to Pacific Financial's whiteboard, you'll see a simple diagram explaining our proprietary IV gauge. The IV gauge displays the probable ranges for a stock's future price by plotting the implied volatility of the stock or future or portfolio over any period and linking it to its chart. Before going on, let's examine what implied volatility is and how it can be used to plot an estimate of the stock's future price range. I'm going to assume that everyone knows what an option contract is and is familiar with the vernacular like puts and calls, strike price, and expiration date. I'm also assuming that you know that option prices are based on 6 variables, 5 being known facts and 1 being unknown, and that's implied volatility. Because implied volatility is unknown, it's a good faith best efforts estimate of the likely price range through expiration, and in fact is the stock price's expected standard deviation through expiration. Now that's great because we know that the first standard deviation is a range or a distribution of outcomes expected almost 70% of the time. And the second includes 95% of expected outcomes, while the third 99.7%. Now this isn't just theories, this is the method used by insurance companies to price premiums for health, car, life, and hundreds of other insurance contracts. It's also used throughout industry for quality assurance, leasing and warranties, even purchasing and distribution. And statistics even drives marketing research about how much product consumers are likely to buy, how much to pay for advertising, customer satisfaction, even what's on TV. So you name it, statistics are everywhere, and statistics provide a framework to predict the likelihood of events, and option prices are based on that methodology. First, we'll start with a bell-shaped curve using the current price of $20 as the mean. Filling in prices to each side, we see that XYZ's IV expects each standard deviation to be $5 on either side. And we know that means there's about a 70% degree of confidence that prices over the next month will be somewhere between 15 and 25. Well, let's flip that on its side so we can apply this knowledge to the IV gauge. Notice that time is now represented, and that as we get closer to expiration, the likely range gets larger. Tack that to a historical display of prices and we can both see where the stock's traded as well as have an estimate of its likely future range for any time period, in this case next month. Now let's go back to PFT's whiteboard. What we sacrifice in good looks we do gain in simplicity. Here we can see the stock's past prices beginning in January at around $30, went down to 14 where we bought of course, and then drifted higher until March 1st where it sits at 20. We'll use linear lines to represent the IV, and PFT's IV gauge tells us that the market estimates XYZ will trade between $25 and $15 over the next month. Since the IV is the first standard deviation, that means the market thinks there's about a 70% probability that XYZ won't trade below 15 or above 25. So, how do we use this data? Well, remember, we bought XYZ in February at 14. And 14 is a good place to be from, but we aren't interested in visiting it again. PFT's IV gauge shows us that $15 is not only the extreme of probable outcomes, in the extreme of the lower half, all outcomes below $20, of which the likelihood is 35%. Do the math a little more, and we recognize that if XYZ will be in the $15 to $25 range 70% of the time, the probability of it being outside that range, either above 25 or below 15, are 30%. So the chance of being below 15 in the next month, 15%. So if I bought the stock at 14, and wrote it to 20, I've only got about a 15% chance of seeing it go back down below 15. That means I've got an 85% chance of it not going back to 14. That's useful information. So let's summarize. First, contact the OCC and get a copy of Characteristics and Risks of Standardized Options. Not reading that is like trying to do anything else without preparing in advance, except possibly a lot more expensive. Second, option data can be useful for non-trading purposes. In other words, you don't need to trade options to apply option data. Well, if you have any questions about PFT's IV gauge, its use or pricing, or any questions in general, please visit us at pacificfinancialtechnology.com. For now, I'm Brent Threadgill. Thanks.